Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Federal Reserve Chairman Jerome Powell and ECB Governing Council member Klaas Knot speaking at a special event organized by Netherlands Foreign Bankers Association. Claire Jones from the Financial Times was moderating. So we got quite the broad discussion from Fed Chairman Jay Powell.
Yeah, you had a lot of headlines that crossed. Not necessarily anything that moved the needle, but just more of how Jay Powell and the Fed sort of thinks about things. He commented on today's hotter than expected PPI reading, said that it was mixed. He wouldn't call it necessarily hot. He did make the point that you might have to see restrictive rates and they might take longer to work. He definitely said service inflation is one that would take the longest. He kind of ruled out a hike. So kind of steady as she goes,
Yep.
talking through how they think of the economy and still kind of doubling down like, yes, monetary policy is restrictive. Just look at the job market. That seems to be their line.
Okay. I mean, I like the Bloomberg News reporting, doubling down on the need to keep borrowing costs elevated. So that's pretty clear. Let's check in with Ira Jersey. He's Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Again, Ira, I guess Fed Chairman Jay Powell will give him points if for nothing else he's consistent. What did you take away?
Yeah, very consistent. I mean, I think the important line was he hinted that they would just remain on hold for much longer as opposed to hiking interest rates. So, we have to, even though the market was pricing in some risk of a hike by the end of the year, he's basically taken that off the table and just said, look, well, we're going to stay on hold for longer if we have to and not cut, but we're not, next hike is probably not going to happen. Interestingly, we concentrate on the Fed here, obviously, because we're a U.S.-based organization and radio station. But I think some of the stuff going on in Europe was pretty interesting, and that was noted, and including basically the idea that they pre-committed to a cut in June. So in a way, that might actually make the Fed's job a little bit more difficult, because if you have the ECB easing policy when the U.S. still has unacceptably high inflation, that might mean that the Fed has to stay on hold even longer, right? So we have to think about the interactions between these economies.
I'm sure they'd rather not think about those interactions, as they've really tried to sidestep that. But that's so interesting because, the ECB seems to be very much signaling June is going to be a cut. But after that, it's very clear they have absolutely no idea. For the Fed, it really seems to be TBD on when they actually cut. But after that, there's nothing to signal it won't be some kind of normal cutting cycle. That to me seems odd.
Well, the market is pricing for 2025 for very slow interest rate cuts at this point, right? So we've priced out about 100 basis points of interest rate reductions over the next 18 months. And, I think that's just endemic of this idea that you were talking about, Alix, is that we just don't know, right? It's completely conceivable that 6 months from now, we're going to be in the throes of a recession, and the Fed's going to have to be cutting interest rates pretty aggressively in order to stop the economy from continuing to falter. But all the data that's coming in right now on the hard data side is pretty good, right? Even the PPI data today that we were talking about with the services component, you look at services ex trade, which is about half of the PPI, that was up 3.9% year on year. And that's really the sector that's buoying inflation right now, right? It's not goods. Goods are basically flat. Energy goes up and down all the time. Food is actually starting to moderate a little bit, but you still have services prices that continue to go up at a pretty decent clip, and that's a huge sector part of the economy these days. So, how do you get those services wages down? And like Jay Powell noted, things like immigration have helped with that, but it hasn't really alleviated the wage pressures yet in those sectors. Meanwhile, in Europe, you do have a more pronounced slowing in the economy. It's more obvious, but that hasn't shown up in this side of the pond yet. And until it does, the Fed's probably, your base case, I think, at this point has to be the Fed's on hold until they say otherwise, and until we see the data really crack.
All right, Ira, thanks so much for jumping on with us. Really appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, zooming in from our Princeton office.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
get right to our next guest, Eric Martin, international economic reporter for Bloomberg News. He joins us from our Washington, D.C. office. Eric, you've got some reporting out here. President Biden adds tariffs on Chinese chips, critical minerals, EVs. Is this just an election year kind of thing, or is there teeth behind this?
Well, part of this is to protect the investments that the Biden administration has made over the last several years. We've seen, of course, the Chips and Science Act. We saw the Inflation Reduction Act with investments in U.S. production of semiconductors, of green technology. And so part of the idea here is to make sure that the alleged unfair competition, subsidization, and intellectual property theft coming from China do not interfere with the purpose of these investments made by the administration with American taxpayer dollars. So that's part of what is behind the strategy that we're seeing unveiled here today.
Is it preventative, though? I mean, for the EV, for example, China doesn't sell a lot of EVs here. So can you have these preventative tariffs?
Certainly, a big part of that is preventative. They've seen what has happened in, for instance, Europe, where Chinese EVs have started to invade that market. In Europe, earlier this year, the EU announced tariffs on Chinese electric vehicles. Also looking at Mexico, where Chinese EVs make up about 20% of the market. And so even though they're not yet in the U.S., there is this concern about this kind of an similar advance in the U.S. as elsewhere, taking people by surprise and happening very quickly, and so wanting to get out by quadrupling this tariff rate on EVs before Chinese vehicles potentially could flood the U.S. market.
So how about the folks that think about free trade? Are those days over?
Yup.
Well, that's one of the most fascinating things here, right, is that the Biden administration really, until this point, has continued a lot of the China policies from the Trump administration. They've left in place and are leaving in place, in fact, today, tariffs that apply to more than $200 billion in annual imports from China. And so, we're seeing a continuation of the Trump policy to a certain way. I spoke to an analyst who said that this is kind of trying to almost out-Trump Trump in terms of the strategy here, but also the Biden administration feeling like the Trump administration really brought a sledgehammer to what should be a surgery in terms of trying to key in on some important and strategic areas and increasing the tariffs there, but not the across the board, for example, 60% tariffs that President Trump has touted on the campaign trail thus far.
So my home in the world is energy, so I'm really interested in the energy transition. Liam Denning of Bloomberg Opinion is my colleague there, and he was talking about how can you have deglobalization and decarbonization at the same time? And these tariffs, I feel, really try to address that, or don't address that point. How does the administration view that connection?
Absolutely. That is one of the key tensions here, is the fact that China has been the major supplier of things like solar cells and green energy technology needed to achieve that transition that you just spoke about, Alix. And so that's going to be one of the things that we see going forward. These tariffs will be rolled out between 2024 and 2026, but seeing how can they accommodate and continue to move forward the green energy transition at a time when they're also trying to foster growth in the American industry, which really until this point has been swamped by Chinese product and Chinese green energy goods coming into the U.S.
So where do you think the Biden administration wants to take this? I mean, are they geared up? Are they open to like a trade war with China?
Yeesh.
That's a fascinating question. Certainly, nobody is losing points with voters in 2024 by trying to be tougher than the other side on China. We've seen that kind of maneuvering both by former President Trump and by the Biden administration to be tough on China. But again, the Biden administration tries to highlight that they don't see this as an across-the-board approach, that they want to continue doing trade with China in areas that are not a danger to U.S. national security interests, and to really home in on the areas where they see China undercutting the investments being made by this administration and putting at risk U.S. supply chains and the growth of nascent U.S. industries.
All right, Eric, thank you so much for joining us. Really appreciate it. Eric Martin, international economic reporter for Bloomberg News, coming to us from Washington, D.C.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jay Powell speaking. Part of what he also spoke about was in the U.S. non-bank lending area has been growing very fast, but it's not obvious that poses any kind of instability or a loss of stability. So let's dive a little bit more into, say, private credit, for example. Our next guest is sort of right in the middle of it. Patrick Kennedy is founding partner of All Source Investment Management, and their clients are really looking at things all across asset classes like private equity, private credit, private real estate, hedge funds, global equities, you name it, they're looking at it. Patrick, great for you to join us. Thank you so very much. Talk to me about the growth of private credit.
Yeah, absolutely. I mean, I think one stat kind of sums it up. So the private credit market has doubled in asset size since 2018. It's now $2.1 trillion. There's all sorts of private credit out there, but what typically gets talked about most is direct lending, which is basically your most simplistic version of private credit. You're giving a privately held company a loan that's typically backed by an asset. I think that's where the concern is amongst institutional investors and some of the regulators, simply because it's an oversimplified asset class at times. You know, folks think that, okay, it's an asset-backed loan, rates are going to float. So essentially, you're going to get a higher return as rates go up. If rates stay higher for longer, you make more money. And while that's mostly true, there's a lot that goes on underneath the hood, right? So if rates do stay higher for longer, can the company afford to pay that loan, right? And then on top of that, you know, we look at, well, what's the asset backing the loan? Are we comfortable owning that asset? What's the loan to value? So there's a lot that can go into the overall underwriting of that. We like to say that the return is made throughout the underwriting process rather than when the statement arrives, right? So yeah, you know, I think it's important to understand the technicals of any fund, their underwriting process, rather than just taking a broad brush approach at private credit. Because we've had a lot of, you know, statements out there that, oh, the private credit markets are overvalued, they looks like a bubble, things like that. I think, again, it's more at the manager level and making sure that the manager is doing a good job with the underwriting process versus the asset class as a whole.
Hey, Patrick, how about private capital into professional sports? We see the value of sports teams just go up dramatically, almost across the board, everywhere you look. And nobody ever really got poor owning a sports team, it doesn't seem like. Talk to us about private equity, private credit getting into that investment class.
Yeah, that's pretty exciting, right? So there's talks right now with the NFL allowing private equity ownership. As a fan, I don't know how I feel about that, but as an investor, I'm pretty excited for it. So one thing that we looked at recently was the NBA. So the NBA has allowed this model where private equity can come in and buy a minority stake. The way it works within the NBA is 45% of any team's revenue is driven from the actual league. So think media rights, things like that, mostly media rights. And then 55% is driven by the team. So concession tickets, that sort of thing. So what it allows investors to do, though, is invest in a smaller team and still participate in the overall league revenue, which I think is a nice feature. If you look at the big four in general, right? So baseball, hockey, football, and then basketball, all the professional sports teams, they've compounded at about an 18% annual growth rate on average since 2012. So it's been pretty impressive. With the NBA in particular, just because we just did some underwriting on that, we know the numbers pretty well. The NBA, the valuations have outperformed both in the .com bubble and 2008. And our real test was, well, how did it do during COVID, right? Because stadiums were empty. You know, how did those valuations get impacted? And believe it or not, the average team still did a 10% CAGR throughout COVID because of the power of the media rights.
Wow.
Yep.
That's really impressive. I don't know, but when you say something like you never lose money betting on sports, like that makes me nervous. I gotta say.
Yeah, absolutely. So I mean, the way we approach it is rather than buying any individual team, we're looking for a vehicle where we can get ownership in multiple teams, right? So as much as I want my Patriots to win the Super Bowl every single year, I know they're not going to, right? So from an investment standpoint, we look at vehicles that have at least a few teams within it from a minority ownership standpoint. And again, it's exciting because you go back 10 years ago and it was really just the ultra wealthy that could own this asset class. So leave it to private equity to open it up for other investors.
So got about 30 seconds left, Patrick.
Yeah.
To what extent do you think these big tech companies like Netflix, Amazon are going to really get in a big way in terms of investing in sports or sports broadcasting? How do you think that's going to work?
Yeah, I mean, you see Amazon going in right now, right? So they own Thursday night. It's not too many organizations that own a day of the week, right? Yeah. So I think it's very powerful from a media rights standpoint. You've heard, for the last 10 years that media rights have been bid up to the point where the valuations don't look attractive and that sort of thing, yet they continue to power forward. So my view is I think that with Netflix coming on board and Amazon coming on board, that may continue for a bit. Again, Amazon has just entered the space with Thursday night games. I think they're going to try and expand that. Netflix is now talking about getting into it. So if it really ramps up on the streaming side, I think those valuations can continue to get bid up for some time.
Wow, that'll be interesting to see. All right, Patrick, thank you so much for joining us. Patrick Kennedy, he's a founding partner at All Source Investment Management, looking at the private capital, the private equity, the private credit, with a little bit of a focus on sports franchises. And again, there are some opportunities for private equity to get into the NBA, not yet into the NFL, but they are looking at it. And knowing the NFL, they will get as creative as they need to be to get access to that capital.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix here with Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business and economics through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies in 140 industries all around the world. And we're joined by one of them right now. Drew Redding, Bloomberg Intelligence U.S. Homebuilding analyst, is joining us on Home Depot earnings. So that stock is down by about 0.7%. We're looking at, quote, continued softness in certain larger discretionary projects. That's never good to hear. And that same-store sales just not great. And spring was delayed. Drew, where do same-store sales bottom out here?
Yeah, so sales were down about 3%. As you guys heard, that was the sixth straight quarter of declines. A little bit below consensus, but I think it was really in line with what the buy side was probably looking for. And I think that's why you're seeing a muted stock reaction today. I think the important thing to note is that they reiterated their full year view. So all in all, not much in the quarter that changes the thesis. In terms of when things bottom out, I think the widely held view is that as we get to the late part of this year, second half into the fourth quarter, you could start to see same-store sales start to inflect. Maybe you get a little bit of a helping hand from housing as we exit the year.
So Drew, give us a sense. What are these companies, the Lowe's and the Home Depots, what are they saying about their customer base? I mean, are they stretched? Are they struggling? Have they spent all their stimulus? What are we hearing about the consumer from these two companies?
Yeah, great question. I mean, the Home Depot and Lowe's consumer tend to be homeowners. That's their predominant customer. They tend to be higher income, so they're a little bit more well off. But look, they're still at the mercy of everything that's happening in the broader economy. You've got the cumulative impact of inflation over the last several years. You've got a weak housing market. And what we're actually hearing is that a majority of the weakness is centered around those big ticket discretionary categories. An interesting dynamic within that they actually alluded to during the conference call is that over the course of the last year, a lot of the weakness in big ticket was concentrated in those categories that were pulled forward during the pandemic. So they call them single item purchases, things like grills, patio furniture, outdoor power equipment, things that you tend to purchase once and then you don't need for a while. But they're starting to note a normalization in those categories, which is an encouraging sign. On the other hand, where they're seeing more weakness
is in the categories that tend to be debt financed, where those higher interest rates are having an impact on the consumer. So they called out, kitchen cabinets, countertops, really kitchen and bath, and that's about 7% of their sales. So it's an interesting dynamic that's at play there.
That is. So, and it all points to what we're kind of learning about the consumer anyway. So John Tucker, when he's redoing his closet to his bathroom, is going to a contractor supply store to buy stuff because it's cheaper.
Well, it's not cheaper. It's just if you're going to do something like that, a big project, you go with quality. And
okay.
My argument is the suppliers to Home Depot, I find a lot of them are kind of junky stuff.
So to that point, how many people are like John Tucker?
Just my opinion.
Sort of just going to different options. And maybe that's a quality thing. Maybe it's a pricing thing.
Yeah, look, I think the home improvement space as a whole is really under pressure. And what we've heard is that, people are deferring their projects. So they're taking, instead of doing that large kitchen bathroom model, maybe they're doing something smaller, or they're actually starting to trade down in certain categories within the kitchen and bath. In terms of, the supplier situation, and it's an interesting dynamic that, you mentioned plumbing and, where are contractors purchasing their goods? Is it Home Depot or is it a competitor? The pro market is really the area of focus for Home Depot, and they're attacking it in an interesting way, and that's by going after what they describe as a $250 billion opportunity for more complex projects. And basically what they're trying to do is consolidate supplier relationships. So if you have a contractor who would typically manage a relationship with, a door distributor, windows, decking, plumbing fixtures, they want to take that all under one umbrella, the Home Depot umbrella, and kind of make it a one-stop shop. And that's a big opportunity for them.
Hey, Drew, let's step back. In addition to the home, these retailers, you also follow the home builder sector in general here. I got a 30-year fixed at north of 7% here. I mean, where do rates have to go to free up some inventory in this market here? Because if you talk to a real estate agent, there's nothing going on out there.
Yeah, and once again, I think you need the distinction between what's happening in the existing home market and what we're seeing in the new home market. Rates have come down to just under 7.25% most recently. So that means that when you go into the new home market, the builders are buying down your rate somewhere in the 5.5% range. And that's how they're getting traffic through the door. They're able to make those monthly payments more palatable than what you're seeing in the resale market. Now, we talk about the resale market, and that's really what's important for the Home Depots of the world. It's hard to get excited about, a significant rebound in activity when you have rates that are above 7%. The good news is that, if you could call this good news, is we're hovering at multi-decade lows in transaction activity. So we're probably somewhere at trough levels at this point. So we think as we get through the end of this year and into next year, maybe you start to get a little bit of a rebound. But again, I think, to see more activity, you'd probably need to see rates somewhere in the 6% range.
I think that would make sense. Paul would be refinancing if it goes a little lower. I just want to point out what's happening in the conversation in the radio studio. So, Drew, I'm building on an extension to a house that I have with my husband up in the Berkshires, right? And John Tucker's trying to convince me to do it myself.
Yeah, just go to YouTube.
He's like, go to YouTube. Yeah, just go ahead, rent a hoe and
I didn't say a hoe, a backhoe.
Whatever.
Like a machine.
Or dig up the foundation by hand and put some things down. That's a bad idea, right?
Well, I don't know your experience level, but that sounds like a pretty involved renovation, so you might want to get some help on that one.
You have to have nothing else going on in your life to take on something like that. Is that what we're saying here, John?
I mean, apparently John Tucker says that for his guest house that he dug the foundation by hand.
By hand.
Apparently he
mixed
grew up
it with
in
my
the
own
1700s.
mixer. It was just like I went through like 1,000 bags of concrete mix, but.
So did it pay off for you to do that?
Took me about a year.
Yeah, but is this
broke my back. But I'm a better person for it.
Are you though?
I don't know.
Yeah, and there's Jersey Shore Guest House.
Yeah, exactly.
You guys are all invited.
All right, Drew, thank you so much for joining us here. Drew Redding, he is the home building analyst for Bloomberg Intelligence, joining us from Princeton, New Jersey. I don't think that's gonna.
I'm not gonna do that. Let's just be very clear.
No, I have people who do that for me.
I mean, I'm too tired. There's no way. But to the point that we're probably going to go to Home Depot and buy stuff, though.
Okay.
So we're still, contracting and things like that.
Professional install.
Right. But I find it interesting how the things that are bought on debt are the things that aren't holding up well, which is exactly right.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, last Thursday, I attended the Boston Consulting Group Edge Expo in Boston. I had a lot of great conversations with the execs at BCG, one of which was Brian Collie, global leader for the automotive practice. He focuses on what auto companies should do now to secure their future in a rapidly changing industry. I began by asking him where we are in the evolution from internal combustion engines to EVs and what he's hearing from clients. Let's listen in.
Very excited about the transition that's taken place from internal combustion to battery electric vehicles. And the transition is still taking place. Certainly the news cycle over the last 9 months has turned more negative. I think with good reason. We've had rising interest rates that have changed some of the economics for consumers. We've had a number of vehicle manufacturers that came to market with battery electric vehicles that frankly probably weren't a good fit for particular customer segments, talking large trucks, SUVs, where the battery technology is not yet there to provide the range, the performance in cold weather, et cetera. And we've had a number of quality issues, frankly, as vehicle manufacturers and suppliers are dealing with new supply chains, new component suppliers. The quality, frankly, is lagged on a number of high-profile launches. That said, the underlying economics and drivers of the transition from internal combustion to battery electric vehicles remain as compelling as ever. It was never going to be a straight line, easy path. It was always going to be rocky. I think people are now coming to realize that. But the underlying economics in terms of the regulatory push, in terms of the total cost of ownership as battery prices come down, as we drive greater scale, and most importantly, just the great new vehicles that are coming to market here over the next 5 years, we're very confident that we're still going to see the US market move to battery electric vehicles in a very, very meaningful way.
What do you think, with a smidge of hindsight here, kind of got us to this bumpy patch here? Was it, I've heard anything from affordability to, and I'm sure it's some combination of affordability, I can't find the charger until there's enough chargers relative to gas stations, I'm not a player. What are some of the big issues that you hear back from your companies that they're hearing from their customers?
From a customer standpoint, we actually are trending in the right direction. We had 8% of new vehicle sales last year were battery electric. A lot of the first wave of adoption for battery electric vehicles are many folks who are a two-car family where the charging solution is at home, where it's doesn't need to necessarily cover all of their trips, whether cross country, whatever, maybe where it is frankly more difficult. But for operating in their urban environment or the suburban environment, a battery electric vehicle has shown to be a good fit for their needs. And so from a consumer standpoint, we have made strides in the right direction. 8% penetration last year. We just completed a survey of 3,000 consumers in the US, and nearly 40% said that for their next vehicle, they're going to be looking first and foremost for a battery electric vehicle. They do have some conditions though that they're looking to see. They do want to see a bit more improvement from a range. They want to have more convenient charging on those rare occasions where they are taking the vehicle outside their home market. And they want to see a more attractive price. And that's something frankly that the vehicle manufacturers are giving them through some of the incentives that we've seen on electric vehicles here over the past year. There's also a question though from a vehicle manufacturer standpoint, how do you actually make their business model work? And that frankly I think is the harder problem. The vehicle manufacturers are bringing great product to market. The consumers are excited about the tech infusion, they're excited about the ride, the feel, the experience. That's headed in the right direction. But vehicle manufacturers have to learn how to make their economics work. And today, most vehicle manufacturers are losing lots of money for every battery electric vehicle that they make. Only one player here in the US market is earning profit on their battery electric vehicles. We know who that big player is. Others are struggling. And it requires them to, on one point, both think differently about how are they positioning these vehicles in the market. It's not enough just to be electric. You have to be very clear in terms of who your customer is and position the entire product offering, customer experience, channel support towards meeting the needs of that specific segment. And then you've got to think differently about your cost structure. We need to see greater partnerships, not just across vehicle manufacturers, but between vehicle manufacturers and suppliers. There has to be more collaborative partnerships. There needs to be more platform sharing where you can drive greater scale on individual program economics. And we need to continue to see innovation on the battery front, moving from NMC to LFP to LMFP, different chemistries, that will allow us to reduce our dependence on harder to find, more expensive materials that can also drive greater improvements in range and ultimately a better customer experience. When we get all those things to come together, we do see a path for vehicle manufacturers turning to profit.
I know the consultants are really good at doing nice market forecasts 5 and 10 years down the road. Where do you think maybe just the U.S. market will be in EV penetration 5 to 10 years down? Let's call it 10 years down there, because I think this is going to be a long play.
It is a long play. We do think when you look out over the next 10 years, we expect to see penetration in 40% range of new vehicle sales. And that's when you look at the underlying economics for where we see battery electric vehicles being a best fit for a particular customer segment. We believe the market is there. We believe we get very excited about the number of new products that are coming to market that are frankly far better vehicles than what you could typically get in an internal combustion. We also think that vehicle manufacturers are being very smart in introducing more aggressively hybrid type technologies as a bridge technology to help consumers make the walk from internal combustion to ultimately battery electric, and in some cases using hybrid as that bridge technology, again, for larger vehicles, SUVs, things of that sort.
I'm glad you brought up the economics here, because my auto analyst at Bloomberg, he's an old school auto guy, and he says, listen, Ford ain't going to do anything because they're making so much money on the F-150 that there's no financial incentive for them to really make the big investment. And sure enough, it looks like, at least in the short term, he's kind of right here. Is there a realistic path from a cost of goods sold perspective, from a labor perspective, that Detroit can get to those economics?
They can. And it's not going to be easy. Like I said, it's not going to be a straight line trajectory from where we are today to a all battery electric future. The internal combustion vehicle will continue to be here in the U.S. market for many, many, many years to come, well into the next decade, if not beyond. And that's because there are certain parts of the consumer segments that an internal combustion is the best vehicle for their particular needs. And you do see that when you're talking large trucks, you're talking large sport utility vehicles. That said, if you look at the commitments the United States, Europe, other parts of the world have made towards climate change and trying to combat the warming of the planet, if we are serious about tackling that, then transportation has to do its part. The automotive industry has to do its part. And that's something that I think is independent of whether presidential administration we have. If you look at the states, you look at California, 17 other states have signed up to California, clearly headed towards an all-electric future by 2035. The market is ultimately going to switch over, driven in large part by the regulatory push. That said, as the technology improves, as the supply chain becomes more mature, you're also going to see more attractive economics where it will make good sense for consumers and it will also make good sense for vehicle manufacturers. The challenge that vehicle manufacturers have is how do you actually be the best the way the game is played today, which does favor ICE for larger vehicles and pickups and SUVs, while positioning yourself to win long term. And how do you actually manage that transition in terms of the timing and the sequencing? I will say some of the vehicle manufacturers got a bit ahead of themselves by bringing to market very high profile electric large trucks, SUVs. Frankly, the battery performance wasn't there to support that. We had quality issues. Many of these vehicle manufacturers failed to meet the consumer expectations. And as a result, they somewhat got a bit of a black eye. But if you look at smaller vehicle segments, more mid-sized segments, sportier type segments, an EV is not just a powertrain option, it's a better vehicle. And consumers are seeing that.
It's funny, I did get the Ford F-150 to drive around for a week, and it was an awesome vehicle. First of all, it's the first time I've ever driven a pickup truck, and there will not be a second time, Sebastian. And it's the first time I drove an EV. It was an awesome vehicle. Performance, everything was just incredible. And I was a little surprised that that didn't take off, for example. But I guess my risk is, one of the risks I see out there is, like everything else in this country, EVs become politicized. And there's a certain percentage of people that don't really believe in climate change and therefore won't make a change, I guess, much less pay a premium. Is there concern among the manufacturers that this could get a little politicized here from a business perspective?
Well, certainly there is a strong association between battery electric vehicles and the impact they're going to have on combating the global warming of the planet that exists. And if, like I said, if we're serious about tackling climate change, there is an important role for transportation to play. And presently, the federal, state, regulatory push is pointed in that direction. So no doubt. But I think that what's exciting for me when I look at this is ultimately what's great for consumers. what's going to meet their needs from a functional standpoint, from an emotional standpoint, that's going to give them a fun vehicle, not just to get from point A to point B, but actually be a fun driving experience. And that's where there's been a great evolution over the last decade. When EVs first came to the market, they were very functional, get to point A to point B, cheap.
Yeah.
They were functional people movers. They were boring. They weren't exciting. Now, if you look at all the great vehicles that are coming to market, some are more sportier, more performance. It's about the fun of driving. It's about the acceleration. It's about the handling. It's about the tech infusion. Again, it's not just a better powertrain, but better vehicles, and consumers are seeing that.
All right, that was Brian Collie. He's the global leader of the automotive practice at Boston Consulting Group. Spoke with him last week up in Boston, talking about the EV business. Bumps in the road for sure in the initial number of years of the rollout, but he thinks maybe 10 years, 40% of new car sales in this country will be EVs. So we'll see how that plays out.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.